Well, hello and welcome to Global Mantra Market Outlook 2015 with me, Tanvir Gill. This is a special series that we bring to you each year from the City of London, speaking to a lot of prominent fund managers and market speakers and getting their views into the new year. My guest today on this show is Lacaille, who's a Global Chief Investment Officer at State Street Global Advisors, an asset management company that has assets over $2.42 trillion. You heard me right, $2.42 trillion are the assets under management at State Street Global. Rick, it's great to have you on the show. Thanks very much for taking out the time. Let's look into the new year. 2014 has been good broadly. There have been some weak spots with Europe, Japan, but US has broadly performed. EMs have been differentiated. How are you looking into the new year in terms of opportunities to make money?
Yeah, you could say that 2014 has been a little bit disappointing on the economic front. We had a very weak first quarter in the US. We had some weakness in Europe developing. I think some of that's now dissipating. And from an economic perspective, we see that the US will continue to recover quite nicely and that global growth will be quite close to trend in 2015. So that sets us up quite nicely to consider asset classes. And at the moment, we would expect equities to continue to outperform other asset classes in 2015.
Right. Like I said, you have 2014 being defined by an overweight position in equities. You're saying that continues. What happens to the trade between EM equities versus DM equities? Europe has been weaker this year. Do you think that that poses an opportunity to buy into Europe? And what about the US, where valuation concerns are pretty much plaguing investors?
Well, I think that 2015 will see a continuation of some trends and perhaps development of some new ones. So we've got divergence, for example, in monetary policy. We've got quite a lot of divergence, frankly, in valuations. You picked up a few of those. In some people's eyes, US equities are expensive. We think they're reasonably valued.
Okay, 19, 20 times you think is fair?
We think it's fair value, provided that we continue to see earnings grow. And we can see good reasons why profit margins will stay strong. But I think if you look at global equities, you've got very big divergences in valuation. So the cheaper markets, Europe in particular, perhaps also emerging markets, have quite a lot of economic risk attached to them. And I think investors have a challenging choice to make. They can go for what is a little bit more certainty in terms of economic outlook, like the US, but pay more, or frankly, go for value, but expose themselves to quite a lot of economic risk.
No, but sentiment-wise, are you feeling confident about 2015, given the risk, talk of risk in deflation, in perhaps global growth not recovering, and the fact that there is expected to be a big dollar rally into the new year?
Well, we're always cautious, frankly. I think it's right to think about risk at all times and to try and find ways of mitigating that risk. And I think diversification is a pretty good way of doing so. So when we think about asset allocation strategies, we're diversifying geographically, but also across the asset classes. And that's worked well for us. But we also introduce other ideas as well to try and explicitly control the volatility of client portfolios where they're particularly sensitive to drawdowns. And I think although we've seen a pretty good year on equities, we've had some quite turbulent periods. And we've now seen this pickup in volatility, which again, we think will continue.
Right. So, talking about the specific ideas that you think could make money or still generate that alpha, what are the top ideas that you're looking at for 2015?
Well, I think equities are an important foundation for many clients. And within equity markets, we would be overweight at the moment US equities at the expense of some other markets around the world. And I think that's not to ignore the fact that US equities valuation is quite high, but simply that the economic risk and the chances of delivering on earnings, for example, are somewhat higher in the US than elsewhere. Now, we have got other positions in other markets. I think Japan's got a very interesting policy mix that can also be quite friendly for equity investors. We've got overweights in credit markets at the expense of treasuries. So you could say that we're prepared to take risk in the private sector economy and avoid some of the safe havens.
Mm-hmm. What's the view on the dollar, from a near-term perspective, actually stepping into 2015, given the fact that there is much talk about a strong dollar rally, which would define or make headlines in 2015, and which would be an impediment for what happens with EM currencies, thereby putting a lot of pressure. There's also talk about how if the dollar rally extends itself, you might be at the heels of a currency crisis. How much do you really, consider that even as a scenario?
Yeah, well, it's an important scenario to consider, and I think firstly we have to look behind that and say, why would the dollar be a strong currency? I think there will be an interest rate argument because there may be more divergence in monetary policy. But I think first and foremost, people want to buy assets in the US because the US economy is continuing to perform reasonably well. Now, not strong from an employment perspective possibly, and I think that's created political challenges. But if you look at the performance of underlying assets in the private sector, they've done well. So I think it's a reason why people will want to buy dollars. I think it's not, as we've seen in previous eras, necessarily a response to risk. It's an opportunity that people are seeing in the US dollar. Now, historically, that's caused challenges in some emerging markets. And I think our assessment now would be emerging markets look a little bit different to how they were 5, 10 or 15 years ago. They may be a little bit more resilient to the dollar strengthening. Obviously, there'll be opportunities for those who are orientated more towards exports. And I think in emerging markets, those economies that have the strongest reform programs will succeed in attracting investor capital.
But are you not worried that if the dollar extends itself a bit too much, and the numbers on the street would be, if it goes up to 95, the dollar index that is, that there would be considerable amount of pressure for EM currencies, and that would impact flows into those markets?
Well, there's always a chance that you get a feedback loop between weakening currencies and investors becoming more nervous about emerging markets. And I guess the question...
There's also the comparison of how this could be similar to the Asian crisis in the late 90s.
I think you've got to look at it on a country-by-country basis. In the run-up to the Asian crisis, you had a number of deficits, both trade and fiscal deficits in countries, which meant they were dependent on external finance. The number of countries that are prone to that sort of challenge has certainly diminished. I wouldn't like to suggest it's zero, but many of those emerging countries are much stronger and able to withstand outflows. Now, you still have the challenge of outflows, and hot money going into or out of an economy is a serious challenge if you're trying to implement change. But I think what you'll find in 2015 is that those countries that have the most politically determined leadership and are pursuing reforms that will boost the long-term growth rate of the economy will be more resilient to that short-term hot money.
Okay, so you're allocating more to the US, that's clear. What about emerging markets? And within emerging markets, where are you looking to allocate more capital?
Yeah, well, emerging markets at the moment are as divergent as they've ever been. If you look at valuations from Russia through to the consumer-themed stocks in Asia, you've got very, very different valuations. And that presents a great opportunity set for active management, both at the country level and at the stock level as well. So we'd be interested in countries where there is a valuation discount, and I think we might include China amongst those countries, where we're more certain about the economic outlook, and we're more perhaps convinced that markets have neglected the likely stability of China, and we'd find a little bit of opportunity there.
You've seen that happen this year actually with the Chinese market picking up. It's been one of the key performers aside of India. It's done well. You think that trend is likely to continue? Well,
I think what might happen in China is a continuation of the liberalization reforms in capital flows and capital markets part of the economy. A very, very slow rotation of the economic model from the old export-driven fixed investment spending to more consumer. It's a very slow rotation, and it's accompanied by a slowdown. However, if the slowdown allows those changes to happen, which in the end are beneficial for investors, and we don't have an uncontrolled problem in the credit market, then I think investors will become more accommodating about their view of China. I think that the challenge people have with China is that they know it's got to change, but as it changes, it will be sending out signals that will worry investors, because you will see slowing growth.
Yeah, and there would be a phase of transition which could perhaps confuse investors on what kind of positions to take for the market.
Yes, but bear in mind the key difference between China and some other economies in emerging markets or even developed economies is that the policy levers are much more easily available. in terms of fiscal policy, monetary policy, the ability to withstand a slowing in the economy and stimulate it if necessary.
Which are the other markets that you like in emerging markets for 2015?
Well, we tend to like smaller markets over large ones. I mean, China's a little bit atypical in the sense that our strategy typically is to overweight the smaller markets and tap into the small country effect in Asia, and underweight a little bit the largest countries. So underweighting countries like South Africa at the moment, underweighting some of the smaller Asian countries like Taiwan and Thailand.
Okay. What about India?
Well, India's challenging because the market's been very enthusiastic about the prospects for reform. And you could say the market is discounting a lot of potential future growth. Really? I think if that growth really comes through on the back of a successful reform program, then we'll look back on this as being probably a very interesting opportunity to overweight India.
Sorry, how integral is India to your EM portfolio?
Well, it's very important because it's an important part of the benchmark, apart from anything else. And the opportunity set within India, the breadth of the market, does provide quite a lot of opportunities for investors to seek out value-based alternatives. So I think if we're overweight in India, and I can't say what will happen in 2015 because we do alter our weightings month by month, it'll really be from a position of greater conviction that the reform program really is going to happen and it's going to start to influence earnings.
I'm sure that you're sitting on money when it comes to your India investments for this year, which has been about roughly 30% on the benchmark. How easy would it be for India to continue this run into the next year if, let's say, there's promise of reforms, but we still see implementation delayed a bit?
Well, I think it's like many other countries, not to pick on India individually. Investors like to see a continuous program of things happening. So the decision made on fuel subsidies, for example, was a positive sign that perhaps not an incredibly popular policy decision would be made with the aim of making things better in the long run. And I think what investors like to see is continuous development. What's perhaps less attractive is a lot of noise and then not much action. So if there is continuous, even if it's relatively small changes that are happening all the time in terms of bureaucracy, price controls, other issues which are of interest to investors, then I think the market will be supported.
Will that also support the currency, the Indian rupee versus other emerging market currencies, despite the strength in the dollar?
Well, I guess that you've got to look at the inflation picture as well. So thinking about currencies, I think we detach the currency decision in a sense from the equity market decision. Equity market could deliver quite good earnings growth and be quite attractive, but the currency could still be challenged. We think the currency is not at fair value at the moment, that there may be some potential further weakness. But obviously a lot depends on the inflation outlook and where interest rates are going.
Do you expect inflation to continue to lower in India?
We would expect it to, well, we'd expect it to lower, but the pace is very uncertain.
Okay, since you brought up the subject of inflation, I think one of the key risks in 2015 is going to be about what happens with the inflation scenario world over. And the noises on deflation are just getting louder and louder. How real is the risk to your mind? Because for many of us over the last 10 years, we haven't really seen a big impact from that from a deflationary scenario on the markets. Perhaps Japan is still struggling with its problems, but how much of an impact do you think if that scenario was to get real, would the markets feel on account of it? And would that happen in 2015? Is that a real possibility?
Yeah, I think what you could say we've seen so far is lowflation as opposed to deflation, with the exception of a few countries. And the investor reaction really depends on what it's accompanied by. Oil prices are clearly driving inflation, registered inflation low. That's a backdoor fiscal stimulus. If you begin to see more widespread falls in prices in a country that has high levels of debt, either in the private sector or the public sector, that's a warning sign for investors. So it really depends on that combination of debt and deflation and where the deflation is coming from. But I think it is a concern that investors have got because they can't see at the moment, a way out of it. Monetary policy has been very accommodative. I think there are some radical policies being pursued in Japan, understandably, to break that deflation cycle.
Right, but that's the catch-22. Monetary policy has been accommodative, and yet inflation is not picked up. You have concerns coming in the US where it's below the Fed's target rate. There's also talk about China where inflation prints have been coming lower. Japan, the last reported numbers we have, they've just slipped into a recession. It just doesn't seem to be adding up for a scenario where we could see some stabilization in prices. And from that perspective, I really wanted to understand, would you be preparing your portfolio or taking calls on positions, keeping in mind that this risk could get louder and perhaps bigger as we go deeper into 2015?
Yeah, well, we think with a typical balanced portfolio, we're quite well hedged. I mean, we may well have assets in there that suffer through a deflationary environment like commodities, but equally we're likely to have long-dated bonds and other things that will act as a great hedge. But I think we're not planning for an outright deflation scenario that causes perhaps more of a growth problem in terms of real growth in 2015. So although we're hedged in our thinking, the central scenario is not that deflation will begin to cause a significant growth problem.
So what risk are you preparing for in 2015?
Well, I think 2015 will see, again, pick up in volatility generally as we've got more divergence in monetary policy. So a little bit more currency volatility, a little bit more fixed income volatility. So we've got to be prepared from a risk budgeting perspective for a different scenario. But if I can just come back to deflation for a minute and what the consequences and issues there are. I think monetary policy has certainly been accommodative. We're seeing that coming to an end in the US, even as we've got quite low inflation. But in Europe, the policies perhaps have been muted so far. I think the European Central Bank are trying to do a lot more, certainly in terms of the asset-backed securities purchase program and other things that relate to that. But I think fiscal policy is the one area that has been underexplored in some countries. And I think at a time where you've still got quite high debt levels, that's sometimes difficult for countries to get over. But it's essential to restore demand. So I think the trade deals that we've seen coming out of the G20 are helpful, but I think we also need fiscal.
Okay. The other aspect that everybody would be talking about are US rates. And when do they go up in 2015, or whether rate hikes in the US are a 2015 story at all if deflation risk, the noise around it gets louder?
We think they're on for 2015. So I think the market implied probabilities would tell you that at the end of 2015, US Fed funds will still be at very, very low levels, 25, 50 basis points. We think it'll be somewhat higher than that. The FOMC dot plot's clearly expecting about 1.3%. This is as of September. That can change, as they have said they're very data dependent. But the data are employment data as well as inflation. I think we've seen much more positive employment trends. And I think the Fed will have a desire to renormalize monetary policy. I think they'll be thinking about putting rates up if they are, not to slow the economy down because they're worried about overheating, but simply to get back to a more normalized monetary policy. And yes, they'll have a view as to how that impacts the rest of the world and how it interacts, for example, with European monetary policy. If we've got very, very severe deflation in the rest of the world, that is likely to have an impact on US policy, but we still think we're going to see rises by the end of 2015.
So what is the market pricing in right now? Because somewhere there is opinion that if rates do go up in the US, that the market is prepared for it.
I think the market will definitely react. I mean, the market can be prepared for it in some objective sense. Nevertheless, when it happens, there will be a reaction. There'll be a reaction at the long end of the yield curve, in the equity market, in markets around the world, and in currencies. And I think...
Would it be like a May 2013 reaction when tapering was first mentioned?
I don't think it will be as big a surprise as that. I think that was more of a genuine surprise to the market than rates rising. But I think a lot will depend on the accompanying discussion from the Fed. What is it they're saying when they're raising rates? Are they trying to renormalize policy? Are they worried about, for example, hotspots in the labor market emerging?
One more risk that is important to highlight is if growth doesn't pick up as expected. Even in 2014, there was talk about how the recovery would be strong, but the IMF's numbers reiterate that there is still some pain there. You've had the World Bank also pretty much voice the same opinion. And like you said, Q1 could be challenging given the winter season in the US. if growth doesn't pick up as expected, would the market see a sell-off?
If growth didn't pick up in the US, I think that would be a worry for equity investors because they are relying on earnings to continue growing quite strongly in order to justify the valuations. I think it will be less of a financial crisis than it would have been 3, 4 or 5 years ago because financial structures are certainly a lot stronger in many parts of the world. Now, there are some where they need to be strengthened further, but if you take Europe as an example, the asset quality review and the resulting stress test were, if you like, a credibility builder in terms of withstanding a little bit more weakness in the world economy. But I think the equity market would bear the brunt.
Before we wrap up, just a couple of more ideas as you look into the new year. In emerging markets, given that oil prices are likely to be subdued and the demand scenario there is likely to be compromised, are you going to be looking at oil importing nations because that helps narrow their CAD? So Turkey, India, you're going to be looking at them from would your view be more favorable towards those countries?
Yes, we think they're going to get a short-term benefit. The question is, how far do you extrapolate current conditions into the future? Clearly, at the moment, there's no sign of an end to the weakness in the oil price, but things can change very quickly. Clearly, the markets had this potential weakness in demand, but I think more particularly an uncontrolled supply side. Now, if the supply side becomes somewhat more controlled and more disciplined, the weakness that we've seen in recent months could end quite quickly. So I think organising an investment strategy around that short-term or potentially short-term oil price could be a challenge, but there's no doubt it is, again, a backdoor fiscal stimulus for many of those countries.
Before we wrap up, Rick, your top 3 ideas where you think there is a money-making opportunity in 2015.
I think US equities are certainly poised for an interesting opportunity in 2015 if the US economy continues to perform well. I think small caps in many parts of the world are also interesting because they can be nimble and maybe capture some of the opportunities, and thinking about emerging markets in particular that are available when you've got these possible changes in the wind. And I think, frankly, simple things like investment grade credit. Investment grade credit, certainly in the US, isn't offering a generous return, but the fundamentals are stable. I think we've got an opportunity there to make a little bit of spread.
What about defensive ideas? Top 3 defensive ideas for the new year.
Well, I think defensive ideas are always revolving around treasury markets or safe havens that are going to perform well in more volatile conditions. I think, well, gold's been a little bit challenged this year, and I think is a reflection of the fact the economy's done pretty well, and we still haven't seen much sign of inflation. I think defensive ideas are often very simple ones, again, like US Treasuries, or managing a volatility portfolio that actually explicitly tries to control the volatility of the whole portfolio, and that being a little bit more dynamic in the allocation of the portfolio, and not having so much of a fix and forget approach to asset allocation. I don't think there's any real safe havens within risky assets. US being probably the closest you get to that because of the macroeconomic strength we're seeing.
Well, some would say that India would be a defensive bet in this sort of a scenario, especially in an EM portfolio, perhaps even China, given that the downside risk is limited. Would you agree?
I think the downside risk really depends what you're paying. I think you could have a belief that the Indian economy is going to continue to recover and maybe eventually get to that target of 8% growth. But you have to always think with equity markets, what are you paying in terms of the valuation metrics? And there I think there's a lot that's taken on trust in terms of earnings growth in the future.
Rick, I'll leave it at that. Thanks very much for joining us and giving us your views into 2015. Well, with that, we come to the end of this edition of Global Mantra Market Outlook 2015. Catch you with another special guest next week. Till then, take care.
The last bull market was all about re-rating of tangible assets. This bull market is all about the re-rating of intangible assets. If India commits to reform and delivers on that reform, I'm sure the market can continue to progress.
The only reason the world is not deflating today is nothing to do with American demand. It's to do with Chinese demand and to some extent Indian demand. Buying things that are real companies where you get a share in the economic interest. And I would say that most Chinese companies are not there. India's better and India's different.
The global economy is out of sync and monetary policy is going in opposite directions. India is now less dependent on foreign capital inflows. So this is why I think investors would now give India the benefit of the doubt.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.